Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, how to create, tax-free passive income. This is a topic that I've gotten a lot of questions about. I got a lot of requests. Say, hey, Adam, the self-directed IRA, the solo 401k seems like a really good vehicle to generate passive income. Now, how could I potentially use those vehicles to supplement my income? Income from small business, income from W-2 job. How can I use my IRA or 401k through passive income to supplement my current income? So that's what today's video is about. There's a lot of really cool techniques that I'm going to go through. I'm going to explain what is passive income, the advantages of it, the taxation of it, and then talk about some of the really interesting strategies you can employ, whether it's a traditional IRA, a solo 401k, and especially a Roth IRA, and especially if you're over 59 and a half, including the use of the ROBS, the Rollover Business Startup Solution, and really get into some really cool advanced areas of discussion in terms of generating tax-free or tax-deferred passive income. So without further ado, let's get started. Obviously, you know about me. I'm Adam, tax attorney. I founded IRA Financial almost 15 years ago. About 25,000 clients, almost $4 billion in assets. Why? Because amazing people like you that understand the value of controlling and gaining freedom using your retirement accounts. And I'll say it now. I've said it many, many times in the past. The system's rigged in our favor. Okay, so the people that understand how the system works just get richer. Okay, it's simple as that. If you know how to use the IRA, 401k, Roth rules to your advantage, you will be able to really supplement your wealth in a very tax efficient manner. So that is really what I'm all about, is empowering people through the tax code and the retirement rules on how to become better, smarter, and more successful investors. I've written 9 books on self-directed retirement accounts, including my new one that was just released a couple weeks ago called Mastering the Self-Directed IRA. Strongly encourage it if you are a newbie, intermediary, advanced self-directed IRA investor. There is something in this book for you. Shameless plug, sorry. I'm just really proud of it. It took me almost 3 years to write, not because it's that large, but because I spent so much time getting it to be exactly to the point and no fluff. 3 to 5 page chapters telling you exactly what you need to know of every important self-directed IRA topic. Okay, let's start with today's video. What is passive income? Okay, the whole heart of today's video is explaining how you can generate passive income in a self-directed IRA, Roth, or solo, and how it could help you live off that money or have it go back to your IRA in a tax efficient manner. So down the road, you're going to be able to live off it in a tax efficient manner. So the most common types of passive income are interest, dividends, capital gains, rental income, royalties, and I'm going to throw in business income. Why? Because obviously you can be a passive investor in a business, right? Like a website, like a affiliated marketing company, a side gig, rental, stocks, bonds, cryptos, right? There's a lot of stuff you can do passively and a lot of stuff you can do through a business passively without actively being involved in the business. So I wanted to include business income as a source of passive income. It's still taxed as business income. Okay, so you don't have potential advantages of capital gains taxation. It's taxed like rental income, interest, dividends, if it's a private company dividend, and royalties. But we'll see through the ROBS, there are ways to potentially shelter some of that income from taxation. Okay, so using a self-directed IRA to generate passive income tax-free. So just introduce real quick what a self-directed IRA is. It's basically an IRA that lets you do alternative asset investments. The term self-directed IRA, you're not going to find in the tax code. It's not a legal term. It just really means an IRA that you can do non-publicly traded securities. Okay. You can do a traditional IRA, a Roth IRA, a SEP IRA, a simple IRA, a Coverdell health savings account. You can all self-direct it. And in all those instances, you can invest in alternative asset investments. The solo 401k, which is the most robust plan for the self-employed. The advantage is you can put away $69,000 or $76,500. You can also self-direct like an IRA. From a tax standpoint, an IRA, a Roth IRA, a solo 401k, all the income and gains in the plan will go back to the plan tax-free. So if it's buying real estate, if it's investing in private placements, business, cryptos, gold, private equity, hedge funds, generally all the income and gains from that investment will flow back to the retirement account without tax. Now, if you make contributions to a retirement plan, pre-tax contributions are tax deductible. If you do it in Roth, it's after tax, but so long as you're over 59 and a half and the Roth's been open at least 5 years, it's all tax-free. And the Roth is a very, very important part of today's video because it's an amazing strategy to generate tax-free income. Okay, I talked about the types of IRAs. I don't want to get into the weeds here. In the chat, there's the PowerPoint, so you can read it at your leisure. But it's just important to understand the differences between the traditional Roth, SEP, and Simple. In all cases, you can self-direct. The only difference is the SEP and Simple are created by businesses. Traditional and Roth are by individuals. There's some income limitations for traditional IRAs in terms of getting a tax deduction. So if you make too much money, you may not be able to do a pre-tax IRA. But because of the backdoor Roth IRA, anyone could do a Roth IRA, even if you make $1 billion a year. So just something to keep in mind. I know it's kind of hard to read. I'm working on a new format where the PowerPoint's going to be embedded into the screen. Hopefully that'll be ready next week. I got some comments about that saying it'd be much better. And I'm listening. I'm always listening. I've been married for 18 years. Why? Because I listen. So I'm going to be doing that hopefully next week. So why generate tax-free passive income, right? Like, what's the whole point of today's video? Well, obviously the word tax-free is crucial, right? Passive income is great because you can sit back, relax, and watch that income hit your bank account. Now, if you can figure out a way to do it where you're not paying tax on that passive income, man, you hit the home run. That's the ultimate prize. So you've probably heard lots of radio ads, video ads, internet ads where, hey, I see it on Instagram all the time on my feed where, some guy in a Porsche or a Lamborghini, and he's like, I generated, $30,000 this month of passive income. Some of it's true, some of it's probably not. And then he says, well, I have 8 Airbnb properties. I own 6 affiliated business marketing companies. I own 12 Shopify stores. Like, there's always different ways to do it. And that's what today's video is going to do. But what these people don't understand on Instagram is there's a way to do it where you don't pay tax. Okay. That they're not understanding. And it doesn't work in all circumstances, but it could work. Okay. So the advantage of the Roth and again, the crucial part of today's video is the Roth. Why? Because that is the only way that if you are over 59 and a half and the Roth's open 5 years, you can live off that money tax free. So if you're watching the video and you're saying, I'm 32, I'm 42, I'm 52. Yes, keep watching because I'm going to have some techniques for you. But the Roth IRA won't allow you to live off that money tax free because you're not 59 and a half. Okay. But if you are watching and you are over 59 and a half, yours should be wide open. Why? Because there's a way through using a self-directed Roth IRA or a solo 401k Roth that you can make passive investments, whether you're buying stocks, dividends, cryptos, gold, you're investing in private businesses, private placements, anything that generates passive income like interest, dividends, royalties, rental income, capital gains, you could shelter all that income from taxation. Okay. So that is super, super attractive. But of course, you have to be over 59 and a half, and the Roth has to be open 5 years. That is the ultimate way to supplement your income, right? Let's say you make 100K at your full-time job. Through a self-directed Roth IRA, you could make passive investments and supplement that income by living off the money tax-free, right? That is the crucial aspect that a lot of these Instagram folks just don't get. Yeah, given a lot of them are under 59 and a half, so it may not merit their concern right now. But building the Roth IRA to that point where you are over 59 and a half and you can supplement all your income, generate tax-free passive income in a Roth is the ultimate prize. I mean, that is where the smartest investors are. Now, if you're under 59 and a half, we'll go into some strategies, what you can do to potentially supplement your income. But one thing that will work is even if you are generating passive income, that money's going back to your IRA without tax. So based off the powers of compounding returns and the rule of 72, if you're generating 9% annual rate of return, your money will double every 8 years. So it's always better to generate passive income in a retirement account than in a taxable account. The downside is there are rules in terms of how you can use those funds in your everyday life to buy food and go on vacation. So that's something to keep in mind. Obviously, passive income, financial freedom, right? Sit back and watch that money grow. And you can spend more time with your family and friends and golf or go to the beach or ski and less time working, which obviously is what we all want to do. So passive income outside of your IRA, right? There's two parts to this video. The first part is going to be talking about what happens if you generate passive income inside an IRA. And then I'm also going to talk about generating passive income outside of an IRA, which a lot of those people on Instagram are not telling you about. That $30,000 they made, they have to pay 30% tax on it, maybe 40, depending on where they live, California, New York, where high state taxes. So they're forgetting that. And hopefully they're waking up and saying, oh no, I just bought a Lamborghini and I have great rental properties and I have 10 Rolex watches. They may not realize they have to pay tax on that income. So when you generate passive income inside an IRA, it grows tax-free, which is deferral, compounded returns, which I just mentioned. When you pull the money outside of an IRA, if you're over 59.5, you pay tax on what you pull out. If you're under 59.5, when you pull the money out of an IRA to live off or use, tax plus a 10% penalty, right? There are exceptions like hardship distribution, first-time home buyer, $10,000. But I want to be clear, okay? When I talk about using passive income to live off tax-free, it's much harder to do in a pre-tax IRA during the time you're under 59.5. Why? Because the IRA distribution rules kick in. Okay, we'll talk about the Roths in a minute, which could be a nice solution. With a Roth, as I mentioned, 59.5 in 5 years, you're home free. It's all tax-free. So if you're under 59.5, I wouldn't just say give up, right? I'd say, okay, maybe I can't use that money now, but let me build my Roth. So when I am 59.5 and I really am tired and don't want to work as hard, then you can really supplement your income and live and have a great life or give money to your kids or your family so they could also share in the benefits. So it's not exactly precise to say that, hey, I can just live off my IRA money. Okay. That's not accurate. And again, your IRA money is not for you to live off today. The whole point of an IRA or 401k is to supplement Social Security, supplement your savings in the future when you're over 59.5, preferably. So doing a Roth will give you the best way to shelter all your income and gains from taxation and then pull that money out tax-free. Now, a pre-tax IRA is also very valuable because the idea is that if you have a lower tax bracket when you pull the money out after 59.5, you may be paying only 10% tax on it instead of 25 or 32%, depending on your tax bracket today. And on top of that, that money is growing tax-free in the IRA. Okay, so the Roth IRA really is the heart and central point of the video. I wrote a book, In God We Trust, In Roth We Prosper. I'm a Rother. All my money's in Roth. Why? I'm going to be 50 soon. In 10 years, I'm home free. I'm going to be able to live off all my money tax-free. Okay, so I can supplement my income. I get an IRA Financial, other income, rental income, or other income I have. But whatever I need, I can pull that money out tax-free. And let me tell you, not paying tax on that money is amazing. I'm sure it's going to be an amazing feeling. I've seen it with family, friends, clients. It's amazing. So the idea is building yourself to that point, right? The retirement account system is a long-term play. The winners are the ones that think long-term. The losers are the ones that think today. So if you're watching this in your 20s and 30s and be like, well, 59.5, Adam, like, I don't want to wait 30 years. Like, that's stupid. I don't care. Well, number one, time flies. Let me tell you. I remember 25 years ago, I can remember it like yesterday. Okay. Goes fast. Number two, just some planning will make a world of difference when you're older, when you don't want to work, right? In your 20s or 30s, you should be totally gung-ho to work, right? Full of vim and vigor. Like, this is the time to work. When you're in your 60s, 70s, you shouldn't be working as hard. And this is where the strategy comes in, where you can live off that money, either tax-free or in a pre-tax IRA or 401k at a reduced tax rate. This is literally the best legal tax shelter out there for anyone. and you can supplement your income and live off that money tax-free, which is unbelievable because you're not going to care who's in office, Democrats, Republicans, what the tax rate is, your holding period, your basis. It's irrelevant because it's all going to be tax-free, which is unbelievable. So let's talk about interest, okay? Interest is a very popular passive form of income, right? You do hard money loans, you invest in credit funds. Interest is very tax inefficient if you own it outside of an IRA. Why? You pay ordinary income. Interest is taxed as ordinary income. If you own an interest-bearing asset in an IRA, it's tax deferred. So you go from potentially 37 to 0. It's not capital gains tax of 15%. It's 37 maximum tax. So owning interest investments in an IRA or Roth IRA or 401k makes the most sense. Every interest-bearing investment, hard money loan, credit fund, whatever debt instrument you want to invest in, you absolutely 100% should own it in an IRA, Roth IRA, 401k. If you own it personally, you're going to get killed on tax. Again, peer-to-peer lending, credit funds, hard money loans, everything should be in an IRA or 401k if you are making those types of investments. Yes, the downside is you can't live off it if you're under 59.5 in a pre-tax IRA because you don't want to pay tax and a 10% penalty. And if you have a Roth IRA, you want to wait to 59.5, but let that money grow without tax, right? It's simple math. If you have $100 of interest and you're in the 24% tax bracket, $24 goes to Uncle Sam. If you did that same investment in an IRA or 401k, $100 goes back to you. Simple math, right? Just keep it simple. Dividends. Dividends is another very exciting opportunity in a retirement account. And we'll get to Rob's in 1 second. So if you own publicly traded securities and you get a qualified dividend from a company, there is a reduced tax rate of 15%, which is a very big tax advantage, which is great, which is why I'm in favor of dividend type investment strategies as a passive income play. Again, if you do that in a Roth IRA, when you're 59.5, you can live off those dividends tax-free. Okay. Or in an IRA, all those dividends you accumulate over the years would go back to the IRA tax-free, even if you're saving 15%. But if you're doing dividends outside of the IRA, 15% is better than paying ordinary income like interest or royalties or rental income or business income. So dividends does have a bit of an advantage from a tax standpoint. So if you are doing it outside the IRA, it's not horrible, not a very tax inefficient decision. But if you get dividends from a private company, not a publicly traded company that's on the public markets, but a private company, the dividends are taxed as ordinary income. They're not qualified dividends. So now you're back into the interest bucket, and now it's very tax inefficient. Again, people on Instagram, they don't tell you other stuff. They never mention tax. They just show you their Porsche, their Lamborghini, their Rolex, and say, hey, I'm rich. You should do this. Pay me to do this. And a lot of these folks are smart and they're hardworking and they have great ideas, but they forget to tell you that this income is very tax inefficient and it could be subject to very, very high income tax, which kills you ultimately. Now, the ROBS, the Rollover Business Startup Solution, I mentioned it. It's a structure that allows you to take advantage. Well, there we are. It allows you to take advantage of an exception in the tax code. I wrote a book on ROBS here. Turning retirement funds into startup dreams. It's about 6 years old. I'm going to have to update it. But the core of the book remains accurate. Is under 4975D13, you can use a 401k to buy corporate stock, and the 401k can be owned by a Roth. So a Roth 401k to own corporate stock, and the corporation can buy a side business, an affiliated business, a rental real estate business, a website business, whatever side passive income hustle you want to do, it could do it. They could even do cryptos or other rental real estate. Now, the corporation would have to pay income tax on the gains. That's 21%. So let's say I have 100K in a Roth, 401k, and I say, I'll take 100 grand. I'll invest it in 10 affiliated service business. Okay, so I take the 100K. I set up a C Corp, call it ABC Inc. ABC Inc. adopts a 401k, call it ABC 401k. I move my 100K tax-free from the Roth to the 401k with ABC 401k. ABC 401k then sends the 100K to ABC Inc. In return, ABC 401k gets 100 shares. It owns, let's say 90 whatever percent, or whatever that percent is, depending on who your other investors are. And then that money's in the corp. So let's say that 100 grand I invest in the business, and let's say it generates $40,000 of profit. 21% goes to Uncle Sam. So let's say it's $8,400, and out of so you minus 40,000 minus 8,400, that's 33,600, and that money can then be dividend tax free to my Roth 401k. So there's no two layers of tax there. It's only one layer of tax because I have a Roth owning the 401k. So yes, I can't get around the 21%. Can't get around that. That's hard to do. The only way to do that is passive income in a retirement account. But this is active business income. You pay the 21%, but then the dividend from the corporation to the 401k is not subject to income tax. Okay. And now the Roth 401k has the money. It can reinvest it. Once you're over 59 and a half, the Roth's been open 5 years, bang, tax-free. You can pull that money out. So through Roths, you're able to invest in an active business. Okay. You can even earn a salary from that business. Could be passive, could be active. You pay the corporate tax. I can't get you around that. I'm not that good yet. Although I stay up at night thinking about how I can figure out a way, and one day I will. The dividend gets back to the Roth tax-free, and then you can reinvest in the Roth, buy stocks, real estate, whatever. Or you just pull that money out and live off it tax-free so long as you're 59 and a half. Roth's been open at least 5 years. So the Roth gives you a way to use your money to invest in a passive or active business, earn a salary, generate tax-free passive dividends that you can live off once you're 59 and a half and open 5 years, the Roth. If it's a pre-tax 401k, the dividend's still tax-free to the 401k. The only difference is when you pull that money out of the 401k, it's subject to income tax. But there's some potential workarounds, right? You can do a loan. You can borrow up to 50K of that money tax-free, penalty-free. You do have to pay it back over 5 years at an interest rate of prime, which in August 2024 is 8.5%, but at least you're paying yourself back. But you are capped at the 50K, okay, which is good or not. Some people may need more, others that suffices. So with a pre-tax IRA, with a pre-tax 401k, there's a little bit more tax structuring that needs to go into play in order to maximize the tax efficiency of the distribution. With a Roth, it's simple. Wait 59 and a half in 5 years, you're home free. So capital gains, right? Capital gains, we all know about it, whether you buy any capital assets, stocks, real estate, cryptos, gold, right? Any capital asset, if you hold the asset more than 12 months and you own it outside of a retirement account, you pay a reduced tax rate of about 15%. If you're a high income earner over 650K, you're going to pay a higher capital gains tax rate, with Obamacare around 23.8%. But it's less than ordinary income tax rate. We'll see what the Democrats do. They've talked about increasing, I think part of Biden and now Harris's tax, at least policy, is that they want to increase capital gains to ordinary income tax rates. I'm not sure they're going to get anywhere. It doesn't seem very popular, but who knows, right? They'd obviously have to get the Congress with them. They'd have to get the majority in the House. So we'll see how that goes. But right now, capital gains, at least long-term capital gains tax, is taxed at a reduced rate to ordinary income. If you hold the asset less than 12 months, short-term capital gains, you pay ordinary income tax rates, which is not tax efficient. If you own a capital asset in a retirement account, no tax, right? You buy and sell stocks. Either if you hold it a day, a year, a month, 6 months, 6 years, no tax. Real estate, assuming there's no leverage in an IRA. Gold, cryptos, right? You're day trading cryptos, bang, bang, bang. No holding periods, no short-term capital gains issues, no capital gains tax issues, tax-free, right? So any capital asset you want to own in a retirement account because you literally reduce the tax to zero. Now, it's not as bad as interest. Interest and dividends from a private company taxed at 37% maximum tax rate. Capital gains is reduced either 15 or 23.8, but it's still taxed. Okay, so it's obviously more efficient to own passive capital gain assets in a retirement account. The downside is if you have a pre-tax IRA, you're going to pay tax and a 10% penalty to pull it out before 59 and a half. If you're over 59 and a half, tax, and a Roth, you want to make sure you're over 59 and a half. Rental income is taxed as ordinary income. right? So you get all these Airbnb, short-term, long-term rental income. It's ordinary income, okay? Good, it's money in your pocket, but bad because you have to pay Uncle Sam. Own rental income in an IRA or 401k, good, no tax, right? No tax. So if you, again, I want to generate tax-free passive income, the way to do it is in an IRA, Roth IRA, 401k. Rental real estate's the most popular way to generate passive income. It gives you diversification. You get access to hard assets, hedge against inflation. You also get the ability to appreciate the asset by owning real estate. So I'm a big real estate investor. Well, I believe in real estate. I don't have enough money to buy as much real estate as I want. But I like the fact that diversification, and I like the fact that I get two sources of income, cash flow and appreciation to sell in a capital asset form. If you own it in a retirement account, the one thing to remember is if you have leverage, there's something called UBIT, unrelated business income tax, which if you own an IRA, if an IRA owns real estate, non-solo 401k, the leverage use could impose this UBIT tax, which can go as high as 37%. So some of that rental income could be subject to taxation in a retirement account if there's leverage. If there's no leverage, there's no tax. If you do it in a solo 401k and use a non-recourse loan for leverage, you'll get around the UBIT tax, which is why a lot of real estate investors that are focused on generating tax-free or tax-deferred passive income want to own it in a solo 401k and not a IRA. So royalty, you guys know what royalties, you get it from patent, copyrights, trademark, oil and gas. Their tax is ordinary income, just like interest. And obviously, if you own it in a retirement account, same game. You defer it or shelter it all from tax, which ultimately is the name of the game. Okay, I mentioned the UBIT, the tax-free business income. The Roths is really the best way to generate tax-free business dividends. When I say business income, I can't reduce the tax to zero. So if your IRA owns 100% of a restaurant or an affiliate marketing or a Spotify business, a passive business, and you own it through an LLC, you're going to pay UBIT tax on the business income. That's 37%. Now you can block it and reduce it to 21% through a C Corp, but you're not going to be able to zero out the taxation from passive business income owned by an IRA, a Roth, or 401k. Impossible. That's not possible today. I can reduce it from 37% maximum UBIT. And the problem with the UBIT tax is once you hit a low income threshold of around 15K, you're subject to the highest UBIT tax rate of 37%, which isn't great. So I can reduce the 37 to 21% through the C Corp blocker, but I still got to pay the 21%. But then I can get this dividend tax-free back to the IRA or Roth or 401k as the shareholder. If I owned the business directly through the LLC, again, the UBIT's going to apply to all that income and go much higher than 21%, assuming you have more than 15K. So business income. And what's business income, right? When you look at real estate, I'm actually going to do a podcast on this because there's a very interesting case that just came out. So check out my podcast. I think it will probably drop next week. And it's called Timothy Foradis and Jessica Moore versus Commissioner. It just came out August 2024. And basically, these guys, this husband and wife, they built a apartment complex building, and they try to get the losses from the real estate and try to have it flow through to their tax return. And the IRS audited them and said, basically, you're not an active real estate professional. This is passive. You are a full-time employee. Your wife's a full-time employee. You work 40 hours. Yes, you put some time into this building, but you didn't put enough time in. And in order to get a deduction, you essentially have to satisfy that you're an active real estate professional, okay? And the rules for what is an active real estate professional is this: more than 1/2 of your personal services performed in trades or businesses during the taxable year are performed in real property. And that was hard for them to prove because they have a full-time job. And since they didn't satisfy one, they lost the second. They spend more than 750 hours of services during the year on real property, trade, or businesses. So since they couldn't qualify as a real estate professional, they couldn't get the deductions, and the losses were deemed passive, and it can only offset passive income, not active income. So my point is, sometimes a lot of people think, well, I'm just going to own it outside of my IRA, and it's easier because I'm in the real estate business and I'll get losses. It's not always that easy, because if you're not an active real estate professional, the losses can only offset passive income under Section 469 of the Passive Activity Loss Limitation Rules and 465 of the at-risk rules. So sometimes the argument for owning real estate outside the IRA is, oh, I get all these depreciation, I get all these losses. And that's why this case is really important is, well, those losses may not always actually offset active income because you're potentially passive. You don't spend enough time in the real estate business, so they can only offset passive income. So just something that I want to throw out there because it's an important point. I get a lot from folks to say, Adam, yeah, you always talk about real estate in your IRA, and I'm not a believer. It's always better to own it personally because I get all these depreciation and deductions. And I'm like, okay, are you an active real estate professional? And they're like, no, I'm a full-time software developer. This is on the side. I'm like, okay, it's going to help you offset passive income. It's not going to help you offset your W-2 salary. They're like, oh, no one ever told me that. So that's why you watch these videos. That's what being a tax lawyer helps. I know these rules. I don't know a lot about other areas. I barely can work my Netflix account. My kids have to help me. But I know this stuff pretty well. And that's hopefully why you're watching, and hopefully you can learn from me and I can learn from you based off the questions you ask, is how to generate tax efficient income, right? The rules are there. We have to abide by them, but they're able to be navigated in order to maximize tax benefits. And that's my whole point. So again, coming to this tax-free business income, the ROBS is basically the best way to do it. Set up a C Corp, you can earn a salary. You have the IRA or 401k, the 401k in this case, pre-tax or Roth, own the business and then get the tax-free dividends back to the 401k, convert it in the plan or have a Roth 401k. You got to wait till you're 59 and a half though. That is a wrinkle, and then you can live off that income tax-free. If you don't want to wait till you're 59 and a half, just be ready to pay tax, which again, there may be ways we can offset it, whether maybe there's hardships to get around the 10% penalty, but getting around the tax, the only way to do that is the Roth or the Roth conversion. So again, these are the most popular 2024 that I've seen tax-free passive income strategies from my clients. And I get to talk to so many smart people. Is obviously real estate. Like that's the most popular one. But remember the case I just mentioned. If you think you're going to get losses, deductions, you got to be a real estate professional, 750 hours, or spend half your time doing real estate, which not everyone can do. The fix and flips, the Airbnb. The Airbnb is a big thing. I always see on Instagram these guys, these gals are, living large, and they got 5-6 properties, and they're getting an extra $20,000-$30,000 of income a month. And I'm kind of jealous sometimes because I'm in the office like 9 to 7, busting my butt writing and doing stuff, which I like doing, but it would be nice kind of hanging on the beach for a few days a week. But people do it. I have clients that are doing this stuff, right? Like they're smarter than me. It's just the truth. Dividends and stocks, as I mentioned, qualified dividends from publicly traded companies. The 15% is cool. Getting into a retirement account, zero it out. The interest, the peer-to-peer lending, like the big trend I've seen, and this should be number one, that's on me. Peer-to-peer lending, credit funds, that's been the hot asset for retirement account investors, especially self-directed IRA investors, because you could zero out the 37% to zero, right? Or whatever your income tax rate, because it's not subject to capital gains. And obviously interest rates are higher now, so you're getting bigger numbers, bigger returns, right? So a lot of peer-to-peer hard money lenders, you're getting 15, 18% interest. That's awesome, right? Yeah, this S&P 500, NASDAQ's around 12%. Put money in the bank, get about 5%. Do some hard money loans. And again, a lot of these loans to private businesses are risky in the sense that it's a loan, but these are good businesses that have well-capitalized businesses, but you're getting 10, 12, 15%, which are great returns. Do that in an IRA or Roth or 401k, it's all tax-free. Do it personally, you could be paying your tax bracket on it. So I threw the ROBs in there because if you are doing a side hustle, affiliated marketing, that type of stuff, websites, Shopify. Doing that through a Robs is so tax advantageous. One, you can earn a salary doing it. Two, the dividends from the retained earnings from the company to the 401k are tax-free. Okay. Thirdly, you can live off those dividends through the 401k, whether it's through a loan. If you have a Roth 401k, 59.5, 5 years, it's all tax-free. Okay. So some really, really, really cool strategies to consider in employing passive income strategies. So just to summarize, remember, when you're thinking passive income, think about it inside the IRA, outside the IRA. If it's outside the IRA, you got to know the tax rules, right? Interest, ordinary income. Dividends from private company, ordinary income. Public company, qualified 15%. Royalties, ordinary income. Rental income, ordinary income. Okay. Capital gains, good. Reduced tax rate, 15 or 23.8 if you're a high income earner. If you hold that asset, that capital asset, more than 12 months. If you hold the capital asset less than 12 months, then it's ordinary income tax, which is not good. Now let's talk about inside a retirement account. You own the passive income inside the retirement account. It's always going to go back to the retirement account tax deferred or tax free. The only time there could be a tax imposed is UBIT, unrelated business income tax. How's that triggered? Use leverage to buy real estate, or you invest in a business through an LLC. If you use a C Corp like the Robs, you'll reduce the potentially 37% UBIT tax to 21%. Okay. And then you get tax-free dividends from the 401k, from the Corp, to the 401k. So in sum, the ultimate strategy for generating tax-free passive income is the Roth, 59.5 in 5 years. Okay. That's what you got to remember. Roth, 59.5, 5 years. If you're under the 59.5, then what I'd be focusing on is building my Roth. So there's ways to build the Roth. Roth contributions to an IRA, 7 or 8K. SEP IRAs and simples now allow you to do Roth. Okay. You don't get the tax deduction, but that money is going to grow tax-free. The solo 401k, you can do what's called a mega backdoor Roth, allows you to go 69K in Roth, or you can just do employee deferrals in Roth or profit sharing in Roth. So there are lots of amazing opportunities to go Roth. Roth is the holy grail. It's the Tom Brady of retirement accounts, the Michael Jordan, LeBron James. That's where you want to be. Pre-tax IRAs are good. Pre-tax 401ks are good, but you got to deal with the income tax down the road. Now, if you know yourself and say, hey, when I retire in my 60s and 70s, I'm going to be playing golf and chilling and hiking and not really working. I don't need a lot of income. Then, being Roth maybe isn't as important because your tax rate will be super low. But if you plan on being active and working and having passive income and your tax bracket will be higher, then the Roth's the ultimate play. It's the ultimate strategy. And that is the best way to get tax-free passive income. Passive income's great. Okay. If you have a W-2 job, you're busting your butt, you're working hard, and you can generate some passive income on the side, even if it's subject to taxation, that is good. I'm not going to say otherwise. That is good. Now, if you can figure out a way to do it tax-free passive income, that's the holy grail. And that is where the Roth comes in. Now, you can employ the Roth through self-directed. You can do it through a self-directed IRA, a 401k, or the Robs, right? The Rob strategy is so interesting to me because you're in your 50s. Let's say you're going to retire. You're going to hit 59.5 in 7 years, 5 years, 3 years, or you're there already. You roll over the money tax-free from an IRA or 401k to this Rob structure. You can then convert it in the plan to Roth when you feel you have the right opportunity. You can convert over a period of years. You then invest in the company. The company invests in passive income, business income. Yes, it's all subject to 21% tax, which isn't horrible, but then all the retained earnings after you pay the tax, you dividend that money tax-free to the 401k. And then the 401k could reinvest it and buy stocks and buy cryptos and gold or reinvest it. Doesn't have to reinvest it in the business. And then you can literally pull the money out of the 401k tax-free once you're 59.5, the Roth's been open 5 years. So some really, really, really cool tax strategies that our clients get access to as clients of IRA Financial. So that's really today's point of the video, is to really introduce everyone that there are opportunities to generate tax-free passive income. It's great to generate passive income outside of your retirement account, but there are ways to do it tax-free. as I mentioned, through the self-directed IRA, Roth, solo 401k, Roth, and the Robs. And that's what we do best. We love chatting with our clients and working with our clients to come up with strategies that minimize tax and maximize tax efficiency. That's what sets us apart. It's in our name, right? IRA Financial. We know IRAs better than anyone. And that's why we're the best at this, because people want to use an IRA company to set up their self-directed IRA. Also, obviously, the 401k. I've written 2 books on the solo K. I'm writing a third. Here's one of them, Solo 401k in a nutshell. My Mastering the Solo 401k will probably come out in, I don't know, within the year. I got some work to do on that one. But I've been working every weekend on writing it. So I hope you found the video insightful, informative, interesting, something to think about. It may not be possible for everyone. Some may say, you know what, I don't want to do a side gig. Like, I work hard enough, and on the weekends, like, I just want to chill with my family. That's cool. But you have to understand how passive income works. Number one, I don't think a lot of people understand the taxation of passive income, the difference between a dividend, a qualified dividend. A lot of people don't know that interest is taxed as ordinary income. Even rental income is taxed as ordinary income. People are amazed to learn that you could shelter all that from tax in a retirement account, understanding deferrals, compounded returns, the power of the Roth, and then putting that into the whole puzzle, including the Robs, I think is really interesting, because you can then take some business income, whether it's passive or active, and turn it into potentially tax-free dividends through the 401k Roth strategy. So that's it for today's video. Hope you guys enjoyed it. Appreciate all the support. If you guys have questions, I put a link to the PowerPoint. If you just want to check it out, feel free to. We have a lot of great content, obviously, on our YouTube channel. So subscribe. You'll get notice when we go live, which I do every week at different points. Also, the podcast, Adam Talks, Ad Mail, Ad Bits, 3 podcasts I drop every week. Upcoming podcast is going to be on that passive real estate case I mentioned, which you definitely should listen to if you are in the real estate world, because I think it's important to refresh your understanding of how these passive activity loss rules work and how it could impact your ability to generate deductions to offset active income. Otherwise, have an amazing rest of your day. Hope your summer is going great, and look forward to seeing everyone again on the next video. Take care and ciao.